Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Sam Buckley, head of our Government of Canada trading desk. This week's episode is titled December Fun. I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Sam, welcome back to the show. It's been quite some time since we've had you on. You have a very busy schedule, so I'm very happy that you had time to share with us this week.
Yeah, there's a lot going on, Ben. As we gear up for December extensions and kind of end of the calendar year, I'd say this upcoming December extension, it is the largest for the long end, but it was probably also the least amount of setup that we've seen, just kind of given some of the uncertainty initially around the budget and a lot of the supply kind of coming down through provincial issuance and a little bit of corporate issuance. We really have not seen the amount of setup that we've seen in the past. So that'll make Monday very interesting.
Okay, so December 1, it is always a big date on the Canadian calendar. This year you're saying bigger. Yes, the math says the extension is larger because our market is bigger. There is more issuance. The roll for 10s coming out of the long index, that because that issue ends up being larger pretty much every year, though maybe not next year, that has tended to make the extension itself larger consistently. Less setup. Does that mean there's a bigger move in rates on the day of if there is less setup?
Yes, I think this year we'll have more of a move on the day. I also think that you'll have, depending on obviously the size of the move, you'll have less people willing to just take themselves short. We're at mid-40s on 10s bonds in Canada, kind of lower end of the range on Canada-US. I don't think that a lot of people are thinking it's a slam dunk just to kind of get yourself put in a steepener or a short Canada-US, where in the past, generally we either richen a lot into the extension or flatten a lot. This has not been the case this year. We flattened relative to the US. The box has moved the better part of 15 basis points since early October, but that was also a function of why we got there in Canada. That was also kind of a Canada-led cheapening on the box dynamic, given we had a lot of long supply, both domestic and international, getting brought back to Canada, and that made for a steep curve in Canada, which allowed that box to get so cheap. But we have richen back. We've seen some profit taking on that on the day. We could see some issuance, but I think that just kind of given the size of the extension itself, we will see buying and we will see flattening, and the curve should flatten. Usually we see a lot of fading into it from accounts, mostly fast money. We could see that again. We will definitely see some of that again, but the theme remains that, and I'm sure we'll get there with the bank, but the curve is already somewhat steep, and we'll see if it really pays to fade it. Looking historically.
So historically, it doesn't pay to fade it immediately, because you still have let's combine DS1 and DS2. So let's put them together as one date. But you still have the December 15th CMB extension and then December 18th BC extension, both of which come at a time where markets are, let us say, less liquid due to the holiday season. Yep. So you're getting that incremental buying, forced buying effectively coming through, and not as much liquidity to deal with that. So maybe, I guess, you get the big strength flattening cross-market outperformance, I guess, on the day DS1, 2, and then that probably sticks for a couple more weeks?
I think so. I think it'll probably stick for a couple more weeks.
And then when do you fade it, I guess?
Yeah, you could probably fade it into year-end, I would say. There's a few international accounts that have different indices that they follow. So they actually have to do their extension on DS 31st, not on the day during the month. So that's probably the time to fade it. And obviously, depending on the stock bond rebalance correlation into year-end, but it probably pays to fade it on DS 31st is when we'll look to fade it. Okay, so patience, I guess, here. I mean, you want to be long into the event and probably stay that way. And then if you're not already, then and you want to look to go the other way, patience pays off in this case. Yep.
All right, makes sense. I think that's pretty straightforward. Any other dynamics there that we should look at?
No.
All right, that no's an answer. I like no's easier than yes in a many minutes long answer. No. So moving on from December 1, December also brings another Bank of Canada meeting. December 10th, we get the bank and the Fed same day for the 5th time this year, I believe, and all 4 meetings in the second half of the year. And nothing is expected from the bank. They are anticipated to stay on hold. They've told us pretty clearly, unless the data materially underperform their forecast, they are done for now. And you can contrast that with the Fed, where it looks as though they will be cutting. The market's kind of been back and forth, and Fed speakers have been similarly back and forth, but it looks as though we are coalescing around a 25 basis point cut and maybe a so-called talkish cut for whatever that means, even though I think there's still more cuts coming. But with respect to the bank, where do you think they go from here, assuming we stay on hold? And how is the market broadly thinking about them at the moment? Are we just setting up for a period of, I don't know, I don't want to say boringness, but low front-end volatility with them just doing nothing for some time?
Yeah, I think the data is going to start to drive from here. I think that coming into the last meeting in October, they had kind of a preconceived notion generally for the past 18 months that they were on a path to lower rates. They've achieved that. They've gotten to kind of the low end of neutral. So I think we're really going to see from the data right now. I mean, twos kind of got close to 250. I think 249 we got up to, which obviously means we're pricing in hikes in the future. Yeah, I mean, I think we'll see. I think it's going to be entirely data driven. How does the USMCA talks go? What are we actually getting in terms of follow through on the federal budget and investments? I think it'll be wait and see. And just the consumers. I mean, we're also, and I think we're seeing this in the US too, and in the jobs data, we're also, I mean, we obviously had a lot of immigration. So some of the supply side kind of distortions that we've seen in the past couple of years could come back around.
Well, they're gone now, if anything. Well, I mean, the bank has highlighted all we need is 5,000 jobs to keep the unemployment rate pretty much steady, to keep the labor market status quo. You said rate hikes.
Rate hikes.
So if you look at the Cora futures curve, it starts to turn higher in the middle of 2026. I think I looked this morning, M6 Z6 was 12, I believe, which seems, I mean, not a lot. Seems like a bit much to me. I mean, and I've said it for some time, like there is a chance they could hike in late 2026, but it's going to take a awful lot of positives coming together. I mean, we're still dealing with USMCA uncertainty probably at least into kind of late next year. I mean, the official negotiating window doesn't start till July. I guess it could definitely start earlier, but we won't know that till the time comes. And there's no guarantee we get a resolution either, and especially not a positive resolution. We may just have no resolution. And the Bank of Canada seems as if they're kind of done-ish for now, fine. And then the question is, like, how impactful is fiscal going to be? And honestly, I don't know the answer. I don't think anybody does at this point. But to get those hikes or to get a hike in 26, like, things have to go pretty good. And then you have more in 27, which at least I can understand. Is that worth fading? Is that something you want to look to fade? Or at 12, it's not worth it yet and wait for it to get closer to 2025 or something like that?
Yeah, I think there's a lot of uncertainty right now. The path of the Fed, who the Fed chairman is going to be, we don't know a lot yet. I think it's going to take a lot of data to come through. It's probably not worth a fade yet. I think you probably want to get a full one.
Okay.
Full one in.
Okay, so like you talked about the Fed. I like that. That's an excellent
I think
point.
they'll be more interesting next year than the bank.
Oh, well, you set the bar very low there. So the banks told us they probably don't want to do anything for a while, whereas the Fed will be way more interesting next year for a whole bunch of reasons. We do get a new Fed chair in May, looking like it'll be Hassett at the moment. Which
that's what they floated yesterday with a
scares me a little bit.
Minimal reaction, I would say.
Yeah,
but I think the market's accustomed to kind of fading some of these things, especially.
Yes, most definitely.
And their minds can be changed quite quickly. So, yeah, the curve steepened
a touch on the back. Yeah,
I think that we'll probably be waiting to the final hours for that one.
Okay, you think so? Well, they've said they might announce it by Christmas. Who knows? Or around then. It does tend to get announced in advance, but this administration has been not predictable in general, for pretty much everything. So you never know how things might unfold. But if the Fed is going to continue cutting, I think it's reasonable to assume that they'll be somewhere closer to 3% by the time we get a new Fed chair. Then the question is, does the new Fed chair continue to cut rates, as the White House will probably be asking at that point? And then to bring it back to Canada, what does that do for the Bank of Canada? Does it make them more likely to cut or less likely to cut? And I would say less likely.
Less
personally.
likely.
Yeah, you think so? Okay.
More stimulative globally. The economy is doing better, right? We obviously have some sort of benefit with that. I find that the path of the Fed will be very interesting next year. If we get down to 3% by the time the new Fed chair is announced, I find it interesting. I imagine for the most part, they all went to the same school. All these candidates went to the same schools, studied the same things. They don't really want to be responsible for cutting into inflation or causing some sort of reinflation spike. So I think that'll be interesting to see how they all manage that. Or if the candidate in the eventual Fed chair is not a traditional economist, then that'll be a whole different thing. But I think that the exuberance could be played down a little bit, depending on where we get to, just given the nature of what could happen, where inflation's running.
Buy the rumor, sell the fact.
Could be.
Okay.
I mean, they also have midterms coming up next year. They probably don't want to see a big spike in inflation.
But they would like to see better growth.
They would like to see better growth. Yeah. But, I mean, depending on how dovish this new Fed chair could be, what could that do to the yield curve and 30-year mortgages? And, I mean, I think there's a lot of risk around that. But, I mean, I think that, as we've seen to an extent, Scott Bessent's in the room, and I'm sure that he'll have a bit of a cooler head at times when it comes to some of this. He
seems to be that way.
So.
Seems to be that way. Hopefully it stays that way, I guess. Okay. So maybe kind of less exciting bank, slightly more exciting Fed, but more cuts either way, at least on the U.S. side of things, and maybe in Canada.
I think we're more likely to cut than we are to hike next year.
Yes. I think through the first half of the year, I don't see it any other way. I think
that's a much more likely scenario. And you posted something in your daily yesterday, your Tuesday note, and it was a Mike Green article that he put through that I thought was a really interesting read. So any listeners that haven't gone through that, it's definitely worth a read through. And it kind of just talks about how the consumers are pretty spent, and it takes a lot to kind of get over the hump. So I think that'll be something that, I mean, will be very interesting to watch. I mean, it has been interesting to watch. So yeah,
it's like, I mean, the broader outline of that, I guess the summary, middle class income thresholds are higher than you think. Yeah, effectively.
Yeah, the cost of living is higher than kind of what the government is.
Well, it's more. I don't know if it's higher. It's that we're looking at the wrong metrics,
yes.
And we're saying that like the cost of living, the basket to some extent is wrong, and the poverty line is wrong, and all of these things are wrong. So I agree with a lot of it. I don't agree with all of it. I think there are certain things in there that you could poke some holes in, but the broader theme I think is probably right on. And you could probably extend it to Canada too.
Yeah,
I think
to an extent.
There are some differences, like just healthcare costs are not as high here. Taxes are much higher on the flip side, and so the marginal cost of from a tax perspective is probably higher at the lower income scale than it is in the U.S. But there's something to it. I mean, it at least creates a reasonable narrative around why consumer sentiment, especially in the U.S., is as weak as it is, given the seemingly underlying strength in the economy and the buoyantness that we've seen in GDP growth and investment generally. So,
one thing I've heard a lot about, a phrase I've heard a lot recently, is the K-shaped economy.
Yes,
I think this note really highlights that. But it points to more cuts, not fewer cuts, which probably exacerbates the more K-shaped economy to continue. So I mean, I don't know what's going to stop this or slow this, but
so that comes to my next, I guess, topic: credit spreads, credit generally. If you have a K-shaped economy, which is driven in no small part by the wealth gap driving material differences between high wealth more than high income, but also high income and lower income folks. And I mean, what stops that? Like, if the Fed's cutting, what's going to stop that? And one of the things that I've been
It's not the $2,000 stimulus checks that.
Well, I mean, that's not going to help anybody for so many reasons. But we can go there if you want. But one of the questions I've been kind of asking myself and select few others is, we have an environment where there is subdued or low volatility, depending on more often than not. Like on average, it does perk up every now and again, but it has been pretty low consistently. Pretty tight credit spreads right across the board on almost every product, but at the same time, heightened uncertainty. And something there doesn't quite mix. Like, you can't have high uncertainty and low vol, and those two don't go together. You could have higher credit spreads. I don't quite see how that works, and where we don't get a break at some point. There's just seemingly an inconsistency there from my perspective.
I think the credit spread discussion has kind of been one that's been front and center for investors for the last five or 6 years, maybe pre-COVID, maybe just pre-COVID, about spreads generally being too tight. It feels like investors have been always looking for more credit. So I think that's part of it. I think yield's part of it. I think higher returns, more money chasing, that is definitely part of it. But I think that you mentioned earlier, and it's from one of our colleagues, with the governments getting more involved in kind of fiscal stimulus, things like that, it is helping smooth everything.
But there's a limit to that. So yeah, and I'd agree. So you have one of the responses to my question from one of our sales guys in Vancouver, Matt Barrett, who I've had on the show previously. He highlighted that you are going to get a lot of fiscal stimulus coming. The one big beautiful bill is going to add, it's anywhere from like 0.25% to 0.5% to GDP growth next year. Canada this year is seeing more stimulus. It's not quite as incrementally positive next year, but there is still that. You're going to have Europe spending more, especially on defense. Germany's going to spend a ton, and so on and so forth. And then Japan seemingly moving in that direction as well. So you do have all of this fiscal, and yes, but there is a limit to this. I guess like that's my issue. Like this is not a sustainable outcome, like a backdrop, really. I guess fiscal can't go forever in providing the stimulus. Yep. There's a limit to that. So I guess we just wait till fiscal runs its course, which is probably, at least on the U.S. side, is probably next year. I don't know if incrementally they can really provide more stimulus given where the deficit and interest rate burden is going. And then if you have the Fed easing also, like there's not going to be anything left at some point next year to keep driving things. So I still think things keep going. Like spreads stay relatively tight here. Risk stays pretty well supported. But as we make our way through 2026 and we get more cuts over and done with, and we get at least toward neutral for the Fed, I'll probably turn a lot more cautious, I think. But maybe I'm wrong. Maybe AI does something wonderful.
I was going to say there's also a lot of exuberance around the idea around AI and what it can do, but also a lot of hesitancy around all the spending that's going on, and that causing maybe a crack in credit's armor. I think we'll see. I think we saw obviously a little bit of a crack over the past 10 days in the equity market, and maybe a little bit of a reprieve in credit spreads. But I mean, I think that
didn't last long.
It didn't last long. So I think
stocks are up another nearly 1% today.
Yeah, and Pro spreads are at the tights. I think it keeps going for a while.
TSX record high.
Yeah, I think we keep going for a while. I think what you said is right. I don't think there's anything on the near term horizon to really push this stuff wider. I think there's still a lot of money that is happy to invest.
I guess that's it. Lots of money.
A lot of inflows.
I tried to see if I could figure out if money supply is driving all this. I could not find any kind of relationship there. It's very hard to find the right money supply metric, especially globally, given how many different metrics there are. But that clearly that has to be part of it.
Yeah, I think it's also, inflows on a weekly basis from paychecks and 401ks.
Yeah, always
buying all this. Like I think there's just a lot more.
That doesn't change, and there's money, at least into Canada, seemingly more international players in Canada, many more, be it from Europe or the Middle East or Asia or wherever. There seems to be more interest in Canada generally. I don't know if that's, and I mean, part of it is the way the U.S. has changed the way they deal with other countries and this trade friction that we see generally. But I almost think it would have come anyways. Like there's just so much capital out there, and I think so. Canada is a somewhat attractive place, at least on a fixed income basis.
Yep.
to deploy your capital. And equity is maybe a different story. But.
And I mean, we saw it when the budget was announced too, right? The market was very happy with the budget.
Yeah, that helps.
So I think that kind of the direction that we're kind of going in as a country in terms of what we're investing in and what we're looking at, I think is attractive for people. They want to hear that story.
I think the budget's a good point, and the fact that Canada is still a AAA, and that is something the government has noted they are keenly focused on. That's something that they want to maintaining that rating and keeping Canada attractive from that perspective to help drive foreign capital inflows. And the direction, we'll see. I mean, I'm probably a little more skeptical than Sam is on where things are going government wise, but I'm hopeful that
I'm open. I think everyone's pretty cautiously optimistic.
Yeah, that's fair. That would be where I am. Cautiously optimistic. Hopefully we can get some projects actually going. My real concern would be like if shovels don't even get in the ground next year, does the optimism wane and then things kind of turn a little more sour? I don't know. I guess I hope not, but something at least to keep on the radar. And then we'll see what trade does next year. Like that's it. Is there any for 2026? Is there anything on your radar beyond trade? Like for me, I'm having a lot of trouble writing my 2026 preview.
Oh, from that, I think I meant trade ideas.
Well, I can do that too. I mean, it's all of the above. There's so much uncertainty as to where we are and where we're going. I think even more so in Canada than everywhere else. It's elsewhere as well, but then double in Canada because of the trade situation. It is challenging to paint a clear picture at all for 2026.
What kind of pickup do we get from if this interprovincial trade stuff is lifted and improved upon?
Well, we should have gotten some of it already this year. Like there's been bits and pieces done already through the course of this year, so it's small there. The estimates are wide. I mean, tenths of percentage points all the way out to multiple percentage points. I would bet on the former and like smaller numbers rather than the bigger numbers. But it will help on the margin. I think what it does as much as help growth is it makes Canada an easier place to do business. And like that is where the focus needs to be. Like just make it so companies don't need to follow ridiculous rules between provinces or federally, whatever they are. Just to lower the burden on companies that want to do business here. That should be the focus. Hopefully it's not, I mean, hopefully the interprovincial stuff helps on its own, but I think it's more that and not chasing away companies with ridiculous rules that matters more. Sure, you said trade ideas before. Anything? I mean, no, it's still too early.
It's too early. It's too early, I think. It seems like curves in the U.S. anyway are going to continue to steepen. So, I mean, I wouldn't fade that.
Yep.
In Canada, I think we'll see. I think, like you said, Canada's a very uncertain place at the moment. We'll see. I think it'll be a range trading environment, at least to start.
Yeah, that's my fear. I'd rather a little more volatility. Yeah. It would be certainly more interesting, but for now, it does seem like things are going to be somewhat subdued. But there's plenty of risk events on the horizon. So, like all the trade stuff at any point in time could really move the needle a lot. And I would say that because of where Canada is from a macro perspective, like the economy's not in great shape. We're just kind of meandering along sideways here. Like Q2 was really bad. Q3 will be out on Friday. It'll probably come in around a half, I think maybe slightly better because trade was positive. And then Q4 is probably tracking 1% plus or minus, somewhere in that ballpark, like just around 1% growth, which again, not great by any means. But what it means is we're kind of vulnerable to any kind of negative shock.
Yeah, I was going to say, like, I mean,
that's the issue.
Canada, yeah, we'll see.
Well, I mean, so we're vulnerable to negative shock. If something bad happens, we might end up with a scenario where businesses who are already very cautious and so far they're just not hiring people, but they're not firing people yet either. Maybe they start doing more layoffs. And then you kind of get a negative feedback loop and things go the wrong way. And then the bank has to cut more, yada, yada, yada.
Yeah.
That's, I feel like, the first half of the year risk. And then it probably flips entirely in the second half of the year. The one positive I have, since we're so negative here, here's a positive. Is I think given the cautiousness of businesses, once the trade uncertainty lifts, there is potentially a lot of pent-up investment that can be unleashed. And so you could have a couple of pretty large quarters for investment. That assumes we get that uncertainty goes away, which it might not. It might just persist, and maybe we don't even get a deal next year, and it goes through 2027, and they just decide to renegotiate this thing every year instead of finalizing something. So I mean, there's a lot of uncertainty there too, but a potentially sizable upside risk, I'd say.
Yep, and the risk that shovels get in the ground quicker,
and the fiscal side. The fiscal is the other one.
So
fiscal might be better. Maybe the investment incentives matter more than anticipated, and there won't be as much pent up demand because you'll have investment actually flowing because of the fiscal incentives that have come through in the tax incentives. So we'll see on that front. That's what to watch, I think, in 2026. Any other trade thoughts, I guess, going into December here? How about fives on the curve?
I like
what
fives.
Do you think?
I like fives. They were seeing a bit of picking away from bank treasuries. They've gotten beat up on the fly by quite a bit. We're the last few days we are seeing a lot of interest in them.
Yeah. All right. Well, that's good for me that at least I called something out right. That's certainly positive. So yeah, fives. I
like fives.
2 size 10s, decent. I don't know. The fly's been one way.
Short the 10-year fly.
Yes.
I think that's a good decent trade.
Good December 1 into.
Yep. And just
trade, and probably through the month.
Probably through the month.
Yeah.
I could see that.
Fair. Fives tend to do better in December as well. So there is some seasonality there as well. Yeah. All right, Sam. Thanks for coming on the show.
Thanks for having me back.
And for our listeners out there, I'll probably try to do one more in December, probably the week after the bank, or maybe the day of the bank. We'll see. Yeah. And thanks for listening. Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.